Hello and welcome to Public Forum. I'm Amandra Bhatt. Today we talk about Monday's bloodbath at stock markets across the world. It was a day of carnage for global markets as the Chinese rout sent shares tumbling in Europe, Asia and the US with hundreds of billions wiped off world's financial markets. The move comes after a sharp sell-off in Chinese shares wiping out gains for a year, with the Shanghai Composite Index registering a 8.5% decline, the biggest since 2007. That comes just a couple of weeks after the surprise currency devaluation of the yuan. All of this has put the global markets in a frenzy. The BSE Sensex slumped over 1600 points or nearly 6% on Monday, marking its biggest percentage fall since 2009, leaving investors poorer by 7 lakh crore rupees. This as the rupee sank to a fresh two-year low of 66.74 per dollar, a 4% decline since China's devaluation. As fear grips world markets about the state of China's economy, many are now wondering whether the worst is over, or is this the beginning of a crisis of the magnitude of one that began 8 years ago, and should India be worried? We discuss. And to discuss the same, we have with us in the studios an eminent panel. Please welcome Dr. Amirullah Khan. He's a well-known economist. Welcome to the program, Dr. Khan. Sitting next to him is Dr. Ramupendra Das, a senior fellow with RIS. Welcome to the program, Dr. Das. Sitting next to him is Professor Dipanshu Mohan. He's an assistant professor of economics at the Jindal School of International Affairs. Welcome to the program, Professor Mohan. We are also joined by Ashok Das Gupta. He's a senior business journalist. Welcome to the program, Mr. Das Gupta. Dr. Khan, let me begin with you. If you could tell us, for the benefit of our viewers, explain what exactly is happening in markets across the world. We've seen globally stocks tanking and a complete mayhem at the BSE.
Thanks, Amandra. It's not as easy a question as you make it out to be. But yes, let me attempt this. Let's see what's happening. There is a very large country, China, the largest economy right now, just behind the US. But what China has been doing over the last few years is building huge amounts of debt. And that's the first point that viewers should know, that when there is tremendous debt, then there is bound to be some problem that comes up sooner or later. China's debt is about, give an indication, it's about 240% of their very large GDP. So it's a very large debt that they have piled up. That's one. Second is that China's economy has been growing incessantly for about 30 years. It was time it plateaued.
Right.
It plateaus and then starts dipping, and that's when the Chinese get a little worried. And the third thing that's happening is that there is general export pessimism around the world. After the crisis that you mentioned, the export markets have contracted, so China's exports have also been dwindling. These three factors put together present a great challenge to the Chinese economy, which is trying to ensure that employment grows, that manufacturing sector grows, and the large numbers of people that are still looking for jobs get them. The last point is that having done all this, the Chinese now realize that there is a great pressure on their banking system. Together, this is the recipe for disaster. Something had to give, and what gave was that the Chinese decided that the yuan will get further weakened, and the moment that happened, the signal went out. People got this, were waiting for this. The moment this happened, they started selling. Now the interesting point is that, so what? People would ask that if all this is happening in China, why is the Sensex in India tanking by 1600 points?
Right. And to discuss the same, we have with us in the studios an eminent panel, Professor Dipanshu Mohan. He's an assistant professor of economics at the Jindal School of International Affairs. Welcome to the program. Professor Mohan, how do you view, the developments of Monday in the Indian context? And we saw a complete state of panic in the Indian stock market as well, and we saw the RBI governor and the finance minister trying to calm down rattled investors, saying that the situation was being monitored very closely and that all of India's macroeconomic problems were under control. Do you think it had anything to do with domestic factors?
Well, not to say that Indian economy per se was responsible. I believe what the RBI governor said, he was very right on saying that India is actually doing much better in comparison to the other emerging market economies. If you look at South Africa's rand or the Mauritius currency or the ringgit or the rupiah, all of these emerging market crises or currencies are not actually very stable. They've been crashing down for some time now. And one of the reasons that triggered it was its overall dependence on Chinese currency, because China is now the regional, the regional superpower, where you can say that the influence of Chinese actions and monetary policy actions have a huge bearing on any of the economies. Where the action plays down to India is that we have been over-relied on a lot of foreign institutional investment over a period of time, which has been triggering activities which has allowed the Sensex to gain. Now, one of the things which I would probably like to add on the table is that the performance of stock market is usually observed when there is a fall of fixed 1500, 1600 points. But when there is a sudden rise of 1000 points or 1500, 1600 points, I think that in itself points out at certain kind of inherent macroeconomic fundamentals not being very stable. So we have to also see that the growth that the Chinese economy is usually given credit of, what is actually the source of the growth, where this growth is coming in from. The pattern of growth in China is very different from any other economy. I usually say that the concept of what Chinese have been able to do is they've emerged this idea of what we have as transitional institutions, where the state is in a way providing the oversight and the state owned in the nature of it, but they're being managed in a very different way, of where certain ways market is allowed to play a significant role. Too much of government influence, I believe, has also been a factor which has rightly added to the debt situation. But more than that per se, I guess the global economy has been a critical factor for reducing the consumer demand for the exports. And this is very similar to what happened in Japan. If you would see what happened a couple of decades back, Japan's economy was not able to recover significantly because it doesn't enjoy a large domestic market as China does, where you can have actions to take place for. India has a similar notion, where I feel it's a kind of a temporary shock. It's not something which we need to be particularly concerned about in the long run, but I think it's a reminder that the government's policies also need to be cautious about how we are susceptible to more foreign investment, and reliance on domestic investment is also a critical factor. So I mean, coupling of all these factors I think are very important. We have to be very cautious, and I guess somewhere the credit has to go to the functioning of the RBI as an institution in not changing the interest rates for a significantly long time, because I think this is one of the kind of reasons where we saw that the RBI saw this coming in a way, because Raghuram Rajan, I believe, mentioned that there is an equity market bubble that's emerging, and it may have a kind of an impact.
Right, and he's also said that he's waiting for the favorable inflation numbers to be able to bring down interest rate. But these signals, Dr. Das, as I said earlier, and Dr. Khan also pointed it out, they have been there for some time now. Singapore is in a state of recession. We've seen negative growth in Japan. We've seen South Korea not growing at 0%. Why are the stock markets crashing now?
I just wanted to say that I think lessons in economic history are very critical in understanding given situations. So we saw a case of 1994 where a similar devaluation happened. China did the same thing. It was also preceded by a federal rate tightening that was done then. And if you would see or notice the situation now, the Federal Reserve had given a clear indication for months that it is planning to basically increase the interest rate. If you would recall what happened in 2013 as well, we saw the currency markets giving us a very negative signal. That was the time where actually Federal Reserve was planning on closing down its quantitative easing plan as well. So I think the Federal Reserve's role is very often underrated to a given situation, understanding what is happening in regional economies. Now, emerging markets have been the source of investment for very long, and it was the same case in '94, which led to, let's say, over a period of time, the East Asian crisis. Now, East Asian crisis and now are two very different times. Of course, our macroeconomic economic fundamentals of economies are much better. There are economies with current account surpluses. China, I believe, has done the same thing, has now reduced interest rates and released a flow of a lot of its foreign reserves to allow for money supply to settle down. But I guess what's important is India needs to have a very clear understanding of how susceptible over a period of time it is going to become if we're going to regionalize our investment pattern. So one of the reasons for that is I'm saying is that there's this whole talk of talking about Asian Infrastructure Investment Bank and bringing the regionalization of credit. I think excessive infrastructural investment from the sides of the government that the Chinese have been doing does not present the same. I think Henry Paulson has recently argued this in his book Dealing with China. Henry Paulson was the Treasury Secretary at the time when the 2008 crisis happened, so he knows quite a few things, and I think that's one of the lessons that he's talking about, that there is a municipal finance model where a municipality in China, what it does is if it runs off out of money, it sells off a piece of land to developers to get access to credit, and that is the kind of internal debt which has now been accumulating, which the state has to see. So India has to be a little bit careful on looking at policies. That's
you spoke about China's manufacturing sector, and there have been allegations that they have kind of built up their manufacturing sector quite unfairly. Do you see these allegations? Do you see them getting intensified as China slows down? Professor Mohan has been wanting to make a point.
Yeah, so I guess there are a couple of things that I guess we need to be concerned about, especially the Chinese state needs to look at. Within the understanding of China itself, if you look at the behavior of Hong Kong and Taiwan, they present some very interesting cases for China itself. Both have had effective state intervention as well, but the market friendliness has somewhere over a period of time allowed these two smaller economies, of course geographically we cannot compare them, but I guess a lot of times what happens is cases from East Asian economies serve as good models in terms of acting behavior. I think what China is doing right now, it's a rebalancing act. They're also reconsidering basically how they need to look at their own economic situation, and I think they believe and they understand that having too much of focus on manufacturing sector, which coincidentally now India is trying to do over a period of time, which it should, but there are lessons to be learned. If you are making for other countries, you need to see that you need to make for your own people as well, and I think that serves as a very good case for India, because we're now looking at attracting investment to come for companies to come in here, allow for processes of invisible innovation to happen, and then serve as markets for the other. And again, I would like to just call in Raghuram Rajan's case of how he had a very diabolical angle to this, where he mentioned that we should be actually making for the people to be allowed to in a way present our own market. The other case is the numbers in China. I'm very skeptical about them. A lot of times we've seen that they have inflated the numbers are looking, and that's where I have a problem with GDP as a measure by itself. If you're looking at growth, aspects of financial markets and growth of financial markets is not best reflected. So I think we have to be very cautious on the kind of parameters we're also looking at. Something like profits to earning ratio, right? Now in China last year, as I was mentioning, it was around $10 to 1. So basically on investing $10 in a stock, you're getting $1 extra. In the US around the same time, it was I guess $18 to 1. In a span of a year, it has jumped to 26 because the investor feels that the company is going to give back a lot of money, and most of these companies have heavy investments in infrastructure which do yield that kind of revenue. But the problem is now that because the export demand has fallen down, it's not reflecting on what corporate profit earnings are. So I guess China needs, a kind of a very good understanding of not only its own market, but also look at other cases of what happened in Japan should not actually recur and happen. On the point of shadow banking, I think that's a big problem.
Very quickly, we're out of time.
Yeah. So trust foundations, $8 billion, that's a huge structure on its own, and the state has been bailing out the investors, and Paulson has been just saying that China does this too often. It bails out its own institutions that are failing. We did it with our non-performing public sector banks.
US also did.
Yes, US did it as well.
Okay, how we're going to do that is going to take another discussion, perhaps another time. On that note, it's time for me to wrap up this discussion here. I'd like to thank all my guests for coming to the studios. It was a pleasure having you all here. That's it for now in Public Forum. Thanks for watching. Goodbye.